In this video, I'm going to take you from a complete beginner to possibly making your first investment in the stock market. This is a super beginner-friendly video with no jargon. By the end of the video, you'll know what the stock market is, how to make money from it, what to invest in, and where to buy it. So let's kick off. So what is the stock market? Let's imagine I'm a chocolate factory owner and my factory starts doing really well. Now I want to open up a factory elsewhere. To do this, I need more chocolate, I need more sugar, I need more stuff, and so ultimately I need more money to grow. As the company owner, there are various ways to do this. The first way is through a bank loan. So I go to the bank and I ask for a business loan, which they could finance with interest. Another way to get the money is for me to go to the public and do a bond issue. A bond issue is exactly the same as a loan, but instead of going to a bank, you're going to the general public to lend you money. The issue with a bank loan and the bond is that I eventually have to repay the principal I asked for. I also have to pay an amount in interest. So if, say, I raised 1,000 euros from the public, I will have to give back, say, 1,500, which includes the principal and the interest over the lifetime of the bond. The third way to get more money is for me to go to an equity investor and to ask the investor for funds. The investor will give me money, but will then own part or most of my business in return. This is what many IT companies have done recently. A number of audit firms actually bought out IT companies to enhance their digital presence. So they bought shares in the IT companies. Another way to obtain funds is to go public and announce an IPO of shares. IPO stands for Initial Public Offering. It's me, chocolate factory owner, going to the world and saying, I'm going to take my chocolate factory, I'm going to split it into 100 pieces, and I'm going to distribute these pieces, being shares, to anyone who wants to buy them. And I'll sell each share in my company for 10 euro, for example. So a couple of years ago, Saudi Aramco raised $25.6 billion from the public, making it the world's largest IPO. This was only around 1.5% of the company's stated value. So imagine what a massive company this is. So back to our chocolate factory. People can now buy and sell shares in our factory. If you buy one share, you'll be owning one out of many shares in the company. So as our chocolate factory starts growing even more people might see potential in actually buying our shares. As demand increases, so does the price of what buyers want to pay. So the price of the stocks that you'd already own would increase. You could then sell these shares for a profit. Of course, the reverse can happen too. The stock market is basically the facility to buy and sell shares. Now, how do you make money from the stock market? Two ways. First, through capital gains. This is very similar to property. Say 5 years ago you bought an apartment for 200,000 and today you want to sell it for 300,000. In this case, you can make a capital gain or a profit of the difference between the price you bought it at, 200k, and the price you should sell it at, 300k. The same concept applies for shares. For example, if you bought 100 Apple shares this time last year and you sold them today, you would have made a profit of over $3,000. Another way you can make money is through dividends. Essentially, companies make X amount of profits each year. Out of these profits, some companies like to take a share of those profits and give it back to shareholders rather than keep it within the company. This is known as a dividend. So imagine my chocolate chip factory had a fantastic year last year, and I have so much money that I decide to give a dividend to my shareholders as a thank you. For many companies, these thank yous stopped abruptly during the pandemic. Many banks, for example, which used to give a dividend every single year without fail, abruptly stopped doing so. And that leads us to what to invest in. Simple. Index funds. Don't put all your eggs in one basket. So say I wanted to buy Microsoft shares. I'd be putting all my money in Microsoft. So if Microsoft ever did badly, the likelihood is my eggs might just get smashed. An index fund is a group of many companies which in turn consist of different baskets based on their sector or their geography. I think of an index fund as a basket of baskets. So if Microsoft did badly one day because the new Windows flopped, then maybe Apple, Amazon, Walmart, and all the others might compensate for that loss. There are many index funds around and most of them have strange names like S&P 500, which is roughly the 500 largest companies in the US. So by buying units in an index fund, you're getting a fraction of all the companies within it, which means you're essentially diversifying. As a beginner investor, index funds or ETFs are a great place to start. So this is my crash course on how to get started investing. Thank you so much for watching. Don't forget to subscribe.